All right. Welcome, everybody. I'm super excited to be here and bring the all-weather strategy to you and talk about it. So I think, why don't we kick it off by, I'm going to share my screen and show you the PowerPoint that I made to discuss tonight. So let's take a look at that. And remember, let's review a few things while we kick it off. Remember, you can ask your questions in the chat and I'm going to answer them at the end. So remember, GLD, global, long-term, and diversified. That is the objective of the all-weather strategy. Global means we're investing globally, not only in Thailand. A tiny amount of the global investment has an investment in Thailand, but it's a global strategy. It's long-term. We're gaining from long-term equity return while trying to reduce a portion of losses during equity market downturns. Diversified. It's diversified globally across 4 asset classes. So today, I'm going to do a little review and show that commodities did well and equities fell. And we're going to look at the performance of the portfolio relative to a 60-40, 60 equity, 40 bonds, and see that we did exceptionally well this quarter, up 2.2%. I'm going to look at the outlook and look at central banks and how they let the West run hot, commodities driven by demand recovery and supply chain bottlenecks. And then I'll look at some regional equity roundup, looking at FVMR snapshots. And then I'll talk about some risks about inflation, quickly getting under control, new lockdowns, Fed hikes, crashing the markets. So let's start off in a review. US is the main driver of global equity, and we can see that stocks, actually what's interesting, and I'm going to grab my pen here since I'm kind of want to go through some interesting points here. What you can see is that, in fact, the world stock market is kind of flat right now after having such a hard, long ride. And if we go into this, we can see in the period of that world stocks were up in the period of 2021 by 19%, and they fell by 4.9% in January 2020. So I'm just looking at that fall right there. And also, if we look at the same statistics on a 5-year period, what we can see is that commodities have been in a bull run for a while now, since April of 2020. And world stocks, again, are up 19% for 2021. Commodities were up by 40% in that period of time. Now, in January 2022, commodities were the only asset class with a positive return, and we did have a heavy weight in there. So I just want to welcome everybody into the group. We've got 163 people on the channel that I'm looking at, but I know we've got people on other channels, and feel comfortable to ask any questions. I see Plun Pun and Sak. I see, let's see who else is on here. So feel free to ask any questions while I'm talking. Just put them in the chat. I see Nok Noi and others. So welcome everybody to the chat, and feel free to ask any questions as I go along. So let's just look at asset class returns. In the year of 2021, stocks were up 19%, but they were down 5% in January. Bonds were down 7% in the year of 2021. They were down 2% in January. Gold was down 4% and down 1.2% in January. And commodities were the main asset class that was up in January at 11.6%. The target weights that we've had for a while, we've made no changes to them. We've been overweight stocks and gold. So we have had some exposure to commodities, but we've reduced that somewhat. So now let's take a look at this for a moment. The U.S. has been a long-term clear leader. What we can see here is that the U.S. market has been the driver of equity markets. I'm looking here at developed Europe, emerging markets, Asia, ex-Japan. By the way, I said that wrong. I meant to say that we're overweight equities and commodities. I had a mistake here. So let me just highlight that this should be 25 commodities. Thank you. And we had 5% in gold. So if I recall that right, 5. Occasionally we make a mistake here in our charts. So I'll just fix it right there. All right. So we can see the U.S. has been a major driver, but that's in question now. Now, if we look at the U.S. versus developed Europe and Japan, we can see that it's really been the developed markets that have been leading the way. And we have been generally overweight the developed markets. And so we have had some benefit there. A while ago, we switched to being overweight U.S. and developed market. And I remember at the time feeling a little bit nervous at the time because, the U.S. market is very expensive. But we also saw that there was strong momentum in those markets, but also more importantly, that the central banks were really supporting those markets, and they had the power because they had the reserve currency power. Think about emerging markets like Thailand as an example. The Thai government can't just print Thai baht to try to stimulate the market and the economy because the Thai baht would end up getting crushed. So that is the situation there. Now, we've been heavy again in these Western developed markets, and in June, we switched that allocation to 25% and shifted down our allocation to the emerging markets in Asia ex-Japan. And we've made no change in the September and December revisions right now. So there are no changes in this strategy. Now, in January, US was the worst performer. The NASDAQ in particular was down 9%. The Fed convinced the market of rate hikes in March, which led to an equity sell-off. But that equity sell-off is tiny compared to what I think is coming to some extent if the Fed starts to raise interest rates. And that's one of my biggest concerns, is that people are kind of complacent right now, thinking that the Fed can raise rates and just get inflation down and the market won't fall. So US tech stocks had the biggest fall. Now, this is a table that you can access, and I'm going to show you the link of how to access it. It's a table that I use all the time, and I put it on my website. So I wanted to show it here so you can look at it. Now, Europe has held up better. Basically, what we see here is, I've just highlighted Europe. Most countries in Europe are loosening or removing COVID restrictions. So Europe was down about 3.2%. Now here we can see emerging markets have generally outperformed and have been doing pretty well recently. And they held up well in January. There's more and more countries that are easing COVID restrictions and opening up. If you go to my website, valuationmasterclass.com, you just go to resources there and you can get access to this tool. Also, if you know anybody that wants to attend the upcoming Valuation Masterclass Bootcamp, just let me know and I'll provide you with a great deal for that as my AWS follower. So US-Russian tensions are a major issue right now. And this is around Ukraine. And basically, it's contributed to some poor performance. And Russia is fearing NATO expansion, and the US fears Russian expansion. Here is a map that I made to try to understand what's happening. Russia aims to supply Europe directly. So around 50% of Russian gas to Europe flows through Ukraine. With Nord Stream 2, which I show on this chart in the red line, Russia aims to bypass Ukraine. And yes, Russia is fearing, US is fearing that Russia is going to regain control of Ukraine. Now, what I would say is that my perspective is that Russia is in a very strong position and they're not desiring to invade Ukraine. I think it's the US government that's making that up and trying to raise tensions. But a big problem they're going to face is that a lot of that oil and a lot of that gas is going to Germany. So, I'm going to continue on. Let's look at Europe and see that it's dependent on energy imports. So I just look at this supply gap, and what I'm showing here is the production versus consumption. And the 15 largest economies in Europe are heavily dependent on energy imports. Only Norway is a net exporter, meaning a negative in this column. The largest economy in Europe, Germany, is highly dependent on Russia for importing. So it's a pretty significant amount of dependence that Germany has, as well as the rest of Europe, on Russian gas. So though the US may try to stoke the fears and stoke a war between Russia and the US, Germany and Europe would suffer dramatically. So this is why Germany stays quiet about Russian activity in Ukraine. What I've shown here is the energy consumption and the energy production on the left side. And there's a supply gap, which is that red line. And here's how they're fulfilling that supply gap. They're filling that supply gap with Russian oil, Russian gas, and Russian coal, and then imports from other places. So Russia accounts for about 20% of Germany's total energy consumption and 40% of net imports. Now, China and India are leading the economic growth right now. I just wanted to look at some growth numbers in also, I've made this chart available on my website. So just go to valuationmasterclass.com and you can get access to this and be able to see it. And I'll update it every week so you can get a picture. But the basically world economic activity rebounded in 2021. And Spain and France's GDP growth numbers came in positive and above consensus in fourth quarter. That's pretty good news. Again, all you have to do is to get these updated numbers on a weekly basis, to use the tools that I'm using, just go to valuationmasterclass.com and go to resources, and you can get a link to it. In fact, Alex is on the call. Maybe Alex can put that into the comments so that people can go and look at it. Now, we've had a low bond target allocation, and we've basically kept it at 5%. The strategy is to hold only Thai government bonds rather than a mix of global and corporate bonds. And most other assets were down in the past month. Hence, a bigger allocation of bonds would have been better. Commodities were up 7% in January 2022. You can see right here. And basically, it was the best performance among all of the funds that AWS invests in. Here we can see the commodities is being driven a lot by energy for sure. That's a major driver, oil price, gas price. And the oil price continued to rise in January due to supply shortage and political tensions related to Ukraine. The West Texas Index oil closed January at $88 per barrel. Wow, we're almost about to hit $90 per barrel. And pretty soon we could be at $100 per barrel. That's an amazing number when you think about the peak of the 2008 crisis was something like $130, $150 per barrel. So we are really up there as far as energy prices. And I think it can continue. And if you create a chart and you look at energy prices, oil related to inflation, you're going to see it's a major input and driver of inflation. So gold is affected by signaled rate hikes too. Gold initially did well in January due to the stock market turmoil and geopolitical games. However, as the Fed signaled more aggressive rate hikes, the U.S. strengthened and the gold price fell back sharply. The U.S. dollar strengthened. Here we can see that gold has just been flat for a while and it's just been holding its position. We have a minimum 5% allocation to gold, which was down by about 0.8 in January. Gold closed December at about 1797 per ounce. So now let's look at the 1 month performance. Remember that this is a long-term portfolio, so I don't like to look at monthly, weekly, daily, but I do update the numbers and go through it and get an idea. So here we can see all of the different asset classes and the different stock markets that we invest in with AWS. And basically the performance was about 2.2% above the traditional 60-40 portfolio. And the best performing asset was commodities, which was up 7%. Developed Europe is second best performing equity, which was down 2.9. And then we also had the worst performer, the US market, in there. But luckily the commodities ended up offsetting that, right? So here we can see that since inception, the all-weather strategy has mostly had a 45 to 65% equity target weight and a 25% gold allocation until recently. The strategy was 3.8% above a 60-40 portfolio by the end of January. And this is including costs related to the funds. So I'm very happy with the performance right now. And most importantly, what I'm happy with is that when the market goes down, as it has gone down, I'm just going to draw on the chart here. The market fell from here to the bottom, and the portfolio fell considerably less from about here to about here. So I'm happy about that performance. I don't like underperforming or I don't like markets going down, but when they go down, I want it to go down less. So AWS has shown strong performance, and it's had a risk-adjusted return that's been very strong, and also has a higher drawdown adjusted return, which I'm happy about. In the past year, the drawdown adjusted return was higher due to higher return. Now, of course, you can say, well, wait a minute, Andrew, the AWS portfolio was down in the last month or the last 3 months, and you're saying you're happy with the performance. Well, the fact is that you're never going to have any strategy that always goes up. I'm willing to see downside. It's just that we have to, see it, we have to protect that downside. And that's what the gold at 5%. Some people ask me, why do you have gold at 5%? Why do you have bonds at 5%? Well, part of it is that we never want to go to zero in some of those asset classes, because gold and bonds are very good protectors when we have downside. So here we can see that AWS has experienced less volatility than typical stock market, let's say. And here we can see that AWS has lost less on 8 out of 10 of the worst days. So what does this mean? If we look at this in more detail, I'm going to bring my little pen here and write something. So hold on one second. When the market was down 5.6% in the 12th of March in 2020, we were down, AWS was down a little bit more than 4%. The market was down 6.4, we were down about 5. So almost every time we were down less than. Here's the first time that we were down more than, and it was just a little bit. And then here's another time that we were down more than, but it was just a little bit. This is the key to AWS, is to try to prevent the downside from being as extreme. Now, if we look at the downside related to equity only, it's much more powerful how much AWS protects the downside. So also we can see that AWS has outperformed the 60-40 portfolio 22 out of 35 months. So that's 63% of the time. But remember what that means. It's about 60% of the time. That means 40% of the time I'm going to be wrong. It's going to be a month where AWS underperforms. And I think you have to keep in mind that that's part of investing, particularly over the long run. You're going to have times that you're, losing. So, don't be spooked when you do have a time of underperformance. Now, let's look at the outlook. Expect Fed to support the U.S. market if needed. American companies are doing well and have global pricing power. U.S. economy is going to remain strong, it seems like, thanks to government spending. Although you could say that government spending certainly slowed down a lot compared to where it was over the last 2 years. And Biden and the Democrats need Chairman Powell to prop up markets ahead of the November midterm elections. And even if the Fed tapers and hikes rates, we expect the course to be reversed as soon as the market starts falling. So think about what I'm saying here, just so you understand it clearly. Everybody's saying that the Fed is going to raise rates. My point is that if the Fed starts to raise rates, it's going to crash the markets. And when it crashes the markets, the Fed's going to have to decide, do we want to keep raising rates into a crashing market to slow down inflation, when we know that also market falls can be deflationary also? Do we want to do that, or do we want to stop the market from falling? I would argue that the history of the Fed now, and the expectation of the politicians and the expectations of Americans, is that the Fed will prevent the market from falling. So I still feel like the Fed, even though the Fed may try to raise rates, they're going to find it hard. Now, the market is certain of a rate hike. You can see right now, 94% probability of a 0.25 to 0.5 target rate raise at the Fed meeting in mid-March. And the market is pricing in on basically 100% certainty of a Fed rate hike. And I think it's possible that they could raise rates, but they'll find that the market doesn't accept it very well. Remember, this market has been propped up by very low rates for a very long time. Just look at the housing market. I was just talking to my sister, who's a mortgage broker in the US, and she was saying it's very quiet. Of course, housing market tends to be quiet in the winter because it's cold. Who wants to go out and look at houses? But still, the point is that the amount of yield, let's say the return or the cost of a housing loan has gone from maybe 2.75 to maybe 3.5 or so. It's a very significant move that's happening in the property market, and that can slow down the sales that are going on in the property market, and that can cause a significant fall in price in there. So in January, the market priced in only a 57% probability of a rate hike in March, and now they're at 100%. So I'm not arguing that everybody, I believe everybody does feel like it's going to happen, and I feel like the Fed wants to do it, but when they come into a falling market, it's going to be a challenge. Now, European recovery is set to continue. Europe appears to be in continued recovery, as shown by Spain and France's GDP growth numbers that we looked at before. More countries are easing or completely dropping COVID restrictions. Yay! The ECB has announced to start tapering, but rate hikes may not happen in 2022. And even though both Fed and ECB talk about tapering and rate hikes, we think the central banks are going to have to support equities if they start to fall. Remember to ask questions in the chat. I see your questions coming in. I'll do my best to answer them after I get through some of these slides. Now, the Fed action hurts emerging markets. Fed rate hikes and tapering are likely to result in a stronger US dollar and less global liquidity, which could hurt emerging markets. While China showed some recent strength before the January drop, it's too early to say that we'll see a strong rebound in China equity from my position. So China looks heavy, and the weighting of China matters. Here we can see China A shares. Basically, China's heavyweight in the emerging markets and Asia Pacific ex-Japan indices is dragging down performance. And if China was to come down further, it would continue to drag some of that performance. So bonds remain flat in the near term. We think bonds are going to underperform equity. This is reflected in our 5% target allocation. Now, it's possible that we could see a U.S. market crash. And if that starts to happen, we would like to have more bonds in the portfolio. But for right now, we're keeping it at 5% along with gold. So you could say 10% of the portfolio is a risk reduction. That's 5% bonds, 5% gold. But we're not yet going heavily aggressive on being, let's say, we're not going heavily defensive, let's say, at this point. Commodities seem still attractive. The last time I talked about commodities, I started to express my concern that I think inflation is getting close to a peak. It may be another 2 to 6 months, but I think we're getting close to a peak. Energy prices should remain strong as the supply-demand imbalance is likely to stay at least at the beginning of 2022. Geopolitical tensions around Ukraine may drive up oil prices further, and global supply bottlenecks seem to remain for a while more. Inflation and recovery demand would be supportive of energy and industrial materials sectors at this point. The main thing that I would say, though, is that it's my feeling that we probably are going to be reaching the peak of inflation very soon. Still, it's an unclear outlook for gold. Unexpected or high rate hikes from the Fed and other central banks could depress gold. We expect central banks to be cautious with rate hikes, though if inflation expectations remain high, it could be supportive of the gold price. More stock market turmoil could also support gold, and we see pressures from both directions represented in our low gold allocation right now. So let's look at our equity roundup. Here's the equity FVMR snapshot. And basically, the U.S. fundamentals are still strong with a very high ROE of about 20%. Valuation has in emerging markets and Japan are both very low. So definitely these are getting more interesting. We're not yet heavily weighted into emerging markets, but I do think that that time will come. The U.S. is up most in the past year. So really, we've caught a lot of momentum in the U.S. market over the past 12 months. And then gearing is lowest in Japan. Now, you may say, well, Andrew, that's crazy. How does Japan have such a low level of gearing when we know it's a huge amount of debt? Well, the debt in Japan is all at the central bank, not at the companies. So the level of leverage at companies and individual level is actually very low. Remember to ask your questions in the chat, and I'm going to get to them as we go through the presentation. So inflation quickly gets under control. That's a potential risk. The all-weather strategy is still positioned to benefit from rising inflation at the beginning of 2022, but there's a risk that inflation is transitory and falls faster than we expect, which could hurt the performance. Just remember also that the inflation rises start to come in, right? Because as we start to do year-on-year comparison, I'm not exactly sure when inflation started rising the most, but I would expect that in the next couple of quarters, the base effect in itself will already be something, the base effect will be pretty massive. So I think that be careful about being overly bullish on inflation being high for a long time. I think also supply chain bottlenecks will eventually work out. I know I got a question for Alex, who's on this call with me, and maybe he can look at this. It's like, when did inflation start to pick up? Because if inflation started to pick up in, let's say, February, March, April, May of last year, then the base effect is going to be pretty significant and bring down inflation going forward. So I'm still overweight commodities and playing inflation, but I still am also cautious about inflation. So new variants could come up, lead to shutdowns. I think politicians who love to have government shut down and economies shut down and love to control the people, these guys basically want to see new variants and all that. But even though we think most countries will be less likely to lock down due to Omicron, it could change quickly. New mutations could also arise, leading to new shutdowns globally. So it could be that that's a risk that we face. Also, the Fed rate hikes crashed the U.S. market. If the Fed would surprise and not be cautious about rate hikes, it could impact the U.S. stock market negatively. The U.S. stock market usually has a global impact, hence it would hurt other equity markets too. The key takeaways from this presentation are AWS significantly outperformed a traditional 60-40 portfolio by 2.2% in January 2022. The Fed ECB unwillingness to crash markets could drive equity markets higher. Recovery demand and supply chain bottlenecks to drive commodities, but I also think that inflation could be getting close to peaking. And the risks are that inflation quickly gets under control, new lockdowns, and Fed rate hikes. So I think I'm going to move into some Q&A now. Before we get into Q&A, for those people, if you know someone that's looking for a career in finance, tell them to join the boot camp that I've got coming up on March 7th. It's a challenging thing. We've had some people from FINNOMENA that have attended, but the main thing is that it's practical, it's focused, it's inspiring, and it's a network. And basically, we have an offer for people who join before February 28th, specifically $400 off. All you have to do is scan that or get the link and get an extra $100 off if you use the code FINNOMENA. So I'm going to leave it there. Alex will have that up there. If you sign up by February 13th, you'll also get access to my Achieve Your Goals course for free. So that's something that I'm open to. So now, Q&A time. Let's go. You guys ready? I've already seen a lot of good questions coming in. So let me just go and start to look at some of the questions, and I'm going to show them up on the screen. So I'm going to go up to the top, and I'm going to see the first question. All right. First question is from Supercon. Says, what do you think about other metals like silver and copper? I would say generally metals are, if they're industrial metals and we see a recovery in the economy, then they're going to be strong. So silver and copper in particular is an industrial metal. So it moves to some extent with the commodity or with the, let's say, the economic cycle. But I'm not the type of person that does a lot of trading in metals because it's just too narrow. And the point of all weather strategy is to try to keep it broad and protect the downside, right? So let's go to the next question. SCB, S&P 500, and TUSFIN A, are these two good investments this year? Yeah, it's hard to say. I mean, right now, I'm overweight the U.S. equity. And basically, it's a scary position. But I also think that part of the argument that we're making is that the developed markets like U.S. and Europe have the capacity to print money to save the market. And that's the reason why I generally have had an overweight position in the U.S. Now, that could change the next time, right? But that's it for right now. Let's look at another one. David says, when will AWS next update a portfolio today? Do you think too much commodity sector that will make the downfall? It's a tough one. The next rebalancing is in a few months. So it's not, I think actually Alex can tell me the exact date of the next rebalancing. So hopefully he can give me that, and I'll tell you about that. But the point I would make is that try to follow exactly what we're doing in AWS, because, when we move, we're moving for a particular reason. Now, you're asking about, do you think that's too much commodity? Yeah, I think that there's a risk. I mean, we've made a lot of return on commodities, and I do think that we're starting to get some risk on commodities. What's been interesting is commodities didn't go down when the equity market went down as much. So commodities actually was not bad. Now, we're going to be rebalancing in early March, so about a month from now. I would say it's hard to see that commodities would come out of the portfolio in the next rebalance. Part of the reason why is because it's just held up very well. So from a momentum perspective, fundamentals, valuation, momentum, and risk, I would say that, that would be the case. So now, next question. Let's see. Ask your questions. Feel free to ask. Supergone Nitty said, good evening. As inflation caused by decoupling of supply chain due to politics, how effective a rate hike really help? Now, that's a great question, because what you're asking is that, is it possible that the Fed can't control things anymore the way they used to? All they had to do was increase interest rates, and then what we would see is that the economy would slow and inflation would slow. But here, what we have is that the Fed, the decoupling of the world, the decoupling of supply chain, means that just because the Fed acts and to increase interest rates doesn't mean that supply chain problems are solved. So I think it is very possible that if the Fed acts, they really, in fact, what I would say, Supergone, is that from my perspective, this is where I think you've got a trade-off that the Fed's going to make. The trade-off is between inflation, fighting inflation, and fighting a falling market. And I think that inflation is going to be a hard thing to fight for them. And so therefore, I suspect they're going to fight a falling market. And the way that they're going to do that is that they're going to basically pull back from their threat of interest rate rises. And that's what I think. So, all right, let's continue on. Let's see. Next question. Make sure to ask your questions. I'm trying to get through every question that we've got. Let's go to the next one. Jen says, in your point of view, when the U.S. falls, when will U.S. funds go up? Good question. I think that's the biggest challenge that I face as an investor, and that we all face, is we never really are going to know. The objective is to have some exposure there, but it's possible that the U.S. funds don't go up by much. But remember, the other thing, there's a very important book behind me here, and that book is called, some of you may know this book, called Portfolio Selection by Harry Markowitz. And it was the founding of the concept of modern portfolio theory. And it was the theory that you can have a portfolio with a certain level of risk, and you can add a high risk stock to that portfolio, or a high risk asset, and actually lower the risk of the portfolio. And this is what modern portfolio taught, and modern portfolio theory taught, and Harry Markowitz wrote about in that dissertation. And the point is that sometimes what you need to focus on is the total portfolio. So yes, I'd love it if I can pick the US exact right time, but you never can. So from that perspective, I can't really tell you when the US is going to come down. Now, if I was to look at it, I would say the Fed's going to start to try to increase interest rates. The market's teetering. I think the market probably could come down if the Fed really moves. And then I think that the Fed eventually is going to reduce that. Remember, we're going into an election in November. The Democrats are already at serious risk of losing control of the government. All that would be left if they lose control of the House of Representatives is all they would have is the presidency through Biden, and that's not much. They won't be able to do much. So keep in mind that if the market starts crashing, the Democrats are going to put strong pressure on Fed to try to prop up the market. So David says, do you think now is the time to decrease the commodity sector in AWS? Not yet. Remember, we follow a very strict system, and every 3 months we revisit it. We've got about 1 month more before we do that rebalancing. And at that time, I'm going to look at commodities, but I try not to make changes in between that. I try to let the market go and let the market run and let my allocations go. All right. Yeah. Plun Pun says, cash is trash or is a king this year? Well, basically, bonds and gold act a lot like cash. So some people hedge their position in their portfolio by just holding cash and holding stocks. Bonds and gold are a way of trying to deal with that. But yeah, if the market crashes this year, then you'll be happy if you have cash. But I'm telling you, timing the market is so hard. I'm sure plenty of you guys have gotten it right and you've gotten it wrong. I've been involved in this for 30 years, and I can tell you it's hard for me, and that's what I do for my living. So some Miss Petite says, some analysts said that Indian stock now is a bit overvalued compared to others. Do you think we should still invest in India or wait till the Sensex is a bit lower and buy on a dip? Well, remember, we're talking about the all-weather strategy, so we're not going to take any big country bets for the different countries. We do take a Japan bet because that's not in the Asia ex-Japan portfolio, but we don't take any bets in countries or sectors like that for AWS. So for AWS, we don't have India in there. Now, to answer the question about India, I would just say that yes, India is high, but it also has a little bit of a lower correlation to the US market. So even though you're a little bit worried, let's say, about the US market, I would say that India still is an interesting market. Whether it's time to sell a little bit and buy back, I think that's something that is kind of dangerous in a sense, because it's hard to get in and out at the exact right times. So Tony Steelsome says, hello, John Andrew. Regarding increasing interest rates by the Fed, is there any possibility for US dollars index becoming depreciation? Yeah, well, I think initially what's going to happen to the dollar is the dollar is going to strengthen because the Fed's saying that they're going to increase interest rates. That's going to lower inflation. If inflation is lower and interest rates are higher, people would be more comfortable to own US dollar bonds that are yielding a higher return and knowing that inflation is lower. So generally, if the Fed could increase interest rates, you'd see strength in the dollar. But I think long term, it's probably more of an issue. It's what I'm concerned is that the dollar value will start to fall and fall significantly in the future, because now the U.S. has just surpassed $30 trillion in debt. So it's a crazy amount of debt. And eventually, I believe that that's going to play out in a declining currency. Supercorn Nitti says, between control inflation to get more votes in the midterm election versus market drop, which one will make the Democrats win? Although everybody cares about inflation, people are going to panic about stock market crash. I believe that the Fed is going to try to solve that problem. Now, you may ask, Andrew, how could the Fed prevent the market from falling? Well, the first thing the Fed could do is they could say, okay, we're not going to raise interest rates, so don't panic. That's the first thing, is they can reverse course on the interest rate. The second thing that the Fed can do is they could say, we're going to buy stocks. They've already done it during the 2020 crisis where they started buying bonds. And now they definitely have the potential they have the ability, and they've got the structure in place where they could quickly say, we're going to incredibly say that they're going to buy the stocks in the stock market. The way that they did it in the bond market was that the U.S. Treasury Department set up a special purpose vehicle, and they injected $50 million into that vehicle. And then the Fed put money or lent money to that U.S. Treasury Department vehicle. And then that money was given to BlackRock. And BlackRock was instructed to buy index funds of bonds. Eventually, BlackRock was asked, and the Fed even went in and did it itself, to buy secondary market and primary market, meaning when companies issue bonds, that the Fed would help the banks to buy all those bonds. So to answer the question, my answer to that is the falling stock market is going to cause much worse problem compared to inflation. And that's the reason why I think that the Fed, though they say they want to control inflation, in the end, when the stock market starts crashing, they're going to have to support the stock market. All right, next one. Penny Pot says, I just want to ask your view on including cryptocurrencies into investment portfolio, maybe just a small percentage. Would that be reasonable for long-term investment? Now, one of the problems about cryptocurrency is that there's no way for me to do it in AWS. We don't have any fund for doing it in Thailand. We don't have any ETF for doing it in Thailand. So the only way that you can really get exposure to cryptocurrency is if you open up an account at an exchange and then you buy some cryptocurrency. Even if we were in America, we would find that there's not that many options for institutional funds to invest in cryptocurrencies. So even though it's a hot item, most of the time, what we're going to see is that no institutions are investing in cryptocurrency. Now, we did have the Grayscale Trust that came out, somewhat similar like an ETF or a fund, but it's what would be called a closed-ended fund, and it's quickly gone to about a 20% discount. I haven't looked at it recently to its NAV, and that's not necessarily a great investment that you're investing in. So the answer to the question is I can't invest in crypto, but you can personally. So now let's answer the question, should you include crypto in your investment portfolio? I think if you like crypto, you like the idea of crypto, you're comfortable with the risk of crypto, then I think you can consider having maybe somewhere, as I say, between 0 and 3% of your portfolio in crypto. Maybe 0 to 3% in crypto. Now, if you're just crazy about crypto and you know all about it, yeah, you may go above that a bit, but I would be very careful because it's not always the case that that's going to be something that's going to last. And keep in mind, already we know in Thailand, there's a lot of regulations coming in from the regulators. And also in the US, the regulators do not like crypto. And so they've been trying to squeeze crypto. All right, next one from Kawin says, for people new to AWS, would you recommend investing in AWS now or wait till the next port adjustment? The thing is that no matter what happens with AWS, you want to adjust the portfolio as quickly and as closely to when I make the adjustment. And so that's the first thing that's important, because sometimes I may be catching some momentum. And when I'm doing that, it just could be the next few days is where most of the gains happen for that quarter, as an example. So what I would say is that generally that's the first thing, invest as soon as the changes happen. The second thing I would say is you've already seen that we haven't made any major changes to AWS in the last couple of months. So I would say that you may not, you may invest now and not wait to the next rebalance, because it's probably better to be in the market over time. So that's what I would say for that one. Fluffy Cotton says, what will be the transition of the market after inflation hits the peak? Maybe in terms of sectors, which ones will be mostly affected? So basically what that means is that the stock market starts to inflation starts to come down, and the companies, first thing you're going to see is bonds should start to do well. So let's first talk asset classes. Bonds should do well. The second thing is that you can say that people have been getting into the inflationary trade by owning commodities. So commodities would do poorly, bonds would do well. The other thing you can say is that any sector that basically can benefit from a falling inflation rate. I think we've got a lot of sectors that could use a lot of benefit from moving goods like shipping and stuff like that. And when the cost of shipping something is really high, it could come down. So if you look at like medical services and service industry, these are industries that probably won't benefit that much from inflation coming down, but companies that are making and industries that are making physical products could see the shipping costs coming down substantially. So a couple of different sectors or ideas there. All right. Plunpun says, your view behind Russia versus US shooting, what's for and how long, and how do you see it ending? So my fear when Biden came into power is that the people behind them want to start a war, in particular with Russia. We saw that there was allegations of Russian collusion by the Democrat Party against Donald Trump for literally 4 years. In fact, there were some people that even until the last day of Donald Trump believed that Donald Trump got into office because of support and collusion with Russia. But of course, we had a huge investigation, Robert Mueller's investigation, which showed that, in fact, he couldn't find collusion even with all the resources that he had. So when the Democrats got into power, now they go back after Russia. And they basically are putting pressure through Ukraine. But the point is, Russia is in a much better situation. Russia doesn't have to do anything. They don't have to move anything. They're not, my impression, and I listened to a lot of different voices on this, but my impression is that Putin does not want to invade Ukraine. He does agree that he has some right and responsibility to protect the Russian-speaking Ukrainians that are in eastern Ukraine. So if the U.S. or people inside Ukraine stir up and start hurting those people, I think he's going to express concern, and he has said that that's his concern. But his number one thing is that the U.S. has been pushing NATO to expand. And the agreement after World War II even was that NATO wasn't going to expand any further. And so Russia's trying to push back. Now, what tools does the U.S. have? The U.S. doesn't have strong ground forces to invade Russia, invade Ukraine. No, they're not going to do that. In fact, remember, Ukraine is not a NATO country. So the U.S. is not obligated to protect that country if another country like Russia was going to invade. And in addition, keep in mind that Germany, as I showed, is so dependent on oil and gas from Russia that they've got to be really careful, because if Germany and Europe get their gas supplies cut off by the U.S. fighting with Russia, they're going to suffer greatly. So I think that basically you see a lot of blaming and a lot of posturing. I see a lot of footprints of the CIA trying to plant stories about Russia and Putin and trying to stir up war. My hope is that they don't do it, but I just don't know at this point. I'm a little bit scared about where that can spin out of control with propaganda coming out of the U.S. So I really don't have a great answer on it, except to say that it would be a stupid move in my perspective from the U.S. They're not in a great position, and they could really hurt themselves, but also hurt Europe and Europe gas and oil supply. All right. Chawa Porn says, an investment in emerging markets is secular trend. What is your opinion about investment in emerging market fund? Well, I think we're getting close. So Chawa Porn, what I would say is that from a secular or a long-term perspective, emerging markets does look good. The problem we face is that if the U.S. market falls, emerging markets always get hit harder. So I'm just afraid that we're not yet. Remember, the reason why I'm overweight the U.S., the reason why I'm overweight Europe is because those countries have the power to print currency, to support their currency, to print currency and support their economies and their markets without depreciating the value of their currencies as much, because they're reserve currencies. And because they have that power and European emerging markets don't really have it, I would just say that right now is not the time to switch to overweight emerging markets. But we're getting pretty close. So if you've got a very long-term time horizon and you can stomach a potential fall in emerging markets if the U.S. falls, then I would say now you could do it. But otherwise, I would wait a little bit on emerging markets. All right. So next says, Kuna Tip says, hello, John Andrew. My AWS, SCB, S&P 500, 23%, KEUX, 23% in SCB principal. Could I rebalance now? You could rebalance, but yeah, you could rebalance. I mean, that's up to you if you want to do it and switch some of that. But the question is, where are you going to put that money right now? And for right now, I would say that I don't have a strong answer for that. I'm going to continue to ride with the strategy we have, and we have a month. And within a month, I'm going to make some adjustments if we've got adjustments to make. If I don't adjust the strategy and the weightings in the next time, and you make a rebalancing right now, you may be in trouble. Now, maybe what you're saying is that you want to just keep the same assets, but keep them in the original balance that we set. Yeah, it's possible that you could do that, but I wouldn't move that aggressively right now. Art says, what do you think about the trend of the baht this year? Well, I think it's ultimately about strong dollar right now. And I suspect that we'll see strong dollar for the next 3 to 6 months. And the result of that is it just puts pressure on the baht. So somewhat of a weak baht is coming from strong dollar. Azola Pinata says, please give your view on China market as ASEAN country versus India, versus China market versus ASEAN versus India. As I say, right now, I'm not that interested in China. I'm a little bit worried about emerging markets. So I think that I would be cautious on these places. India, there's a low correlation to the US market. And so I like that, even though the market's a bit high. So I would say I would focus more on India right now than I would on China or even ASEAN. Now, ASEAN as a whole has tended to have a low correlation relative to the US, but it still would go down if the US market would go down. So I'm careful about ASEAN right now. So Nana says, with no easy money from the Fed hikes in series, it's recommended DCA or market timing after correction. So basically, DCA is not something that you stop doing. Dollar cost averaging is something that you do consistently over decades. And you do it because you believe that you're not going to be able to time the markets perfectly. Sometimes you're going to put money in when it's expensive. Sometimes you're going to put it in when it's cheap. So when you ask me the question about DCA versus market timing, that's not a really good comparison, because once you start DCA, you should stick with it. Now, let's break this apart, though. The next question is, how good are you at market timing? I can tell you it's very hard. And all of my days I spend trying to think about how I properly time the market with AWS. So I would just be careful making a comparison there. All right. Panipat says, thank you, Andrew. Oh, I appreciate it. I've been up since 4 a.m. and I've had a lot of different presentations and things I'm doing. So I'm doing my best to stay alive and full of energy. All right. There you go. From Phenomena, you got some announcements from Phenomena. And then Nana says, in your view, QT is possible this June or Q3. How will the market respond different than Fed hikes? So quantitative tightening basically means that the Fed's going to stop buying. The Fed's going to stop buying bonds. And right now we're seeing what they're saying is that they're going to taper, meaning that as bonds mature, they're not going to go out and buy more government bonds. And so that's the concept of quantitative tightening. And ultimately, quantitative tightening means interest rates are rising. And interest rates rising tend to bring down markets. So eventually, if the best case from my perspective is that that inflation basically starts to taper off, it starts to hit a peak in the next 3 months or so, and that the Fed doesn't have to increase interest rates too much, I would say the market is pretty weak. So that gives you some perspective. Just to go back, I want to just make it clear for AWS that people ask me, do I rebalance now? Do I get in now? I would say follow the rebalancing as best you can. Right now, we're a month away from rebalancing, and I think that, sit tight and let's see what we got. I think that was the last question that I see, and we've almost taken up an hour of everybody's time. If you got any final questions, make sure to put them into the chat right now. Otherwise, while I'm waiting to see if there's any more final questions, I just want to thank everybody for attending, and thank you for considering AWS strategy. I'm doing my best to try to explain exactly what I'm doing. And what you've seen in some of these charts is that I'm going to be wrong at least 40% of the months that I'm going to underperform versus outperform. But remember, it's a long-term strategy. I'm trying to preserve the capital over and grow it over a long period of time. So that's the objective of it. And it's supposed to be a strategy that you can sleep well at night. You don't have to get super stressed out over things. Follow it. I'm working on it every day. And I appreciate you guys for all following it, asking questions, and getting involved in it. Feel free. I want to bring more information to you. If there's more that I can do, let me know. I'm going to sign off now and say to everybody, again, thank you so much. And of course, happy Chinese New Year. I hope everybody is happy in this new year. I appreciate your time, and I'll do my best to continue to communicate what we're doing with the all-weather strategy. So thank you all, and we're going to sign off now.
ในโลกของการลงทุนทุกคนเปรียบเสมือนนักเดินทางคุณคือนักเดินทางแบบไหนมีเงินแต่ไม่มีเวลาเลยไม่รู้ว่าจะเริ่มยังไงใครว่าดีเราไปหมดแต่ก็ไม่ค่อยเวิร์กยังมองหาโอกาสใหม่ๆถึงจะไปมาเกือบหมดลุยเดี่ยวแต่ต้องเจอความเสี่ยงแบบไม่คาดฝัน
กินดอยแล้ว
เพราะโลกของการลงทุนเต็มไปด้วยหลากหลายความต้องการ FINNOMENA Exclusive บริการที่ปรึกษาการลงทุนส่วนตัวพร้อมพาคุณเดินทางไปอย่างไม่โดดเดี่ยวแนะนำเส้นทางที่ใช่ให้คุณเลือกไม่หลงเป็นเมาเพราะเราช่วยชี้ทางออกเดินทางได้สมูทยิ่งกว่าเซลล์ในเส้นทางการลงทุนเดินทางสู่ความสำเร็จตามเป้าหมายของคุณเริ่มต้นลงทุนที่ 500,000 บาท FINNOMENA Exclusive ที่ปรึกษาการลงทุนส่วนตัว